Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
The idea here, of course, is that if the acceleration bands encompass 95% of the price action, I don't want to trade what's expected within the two deviations. I want to trade the unusual occurrence, the other 5% of the price events outside of those bands. You think, well, I'm only trading 5% of the time? Well, of course, in this case, for example, you'd have 6 different vehicles. Plus, we found that through extended testing, these rare events actually happen with more frequency than what the market's models expect, that you're seeing so many more than 2 deviation moves that it's actually happening in the neighborhood of about 15% of the time for a given security. So, it gives you that many more opportunities when you're now following 6 different securities. George Soros, who's the famed hedge fund manager, stated in his book Soros on Soros that it was these unexpected substantial moves, which in the statistical definitions are called the fat tails of the distribution, just meaning that, hey, if these tails are only supposed to be happening more than 2 standard deviations 5% of the time in total, or 2.5% on each side effectively, 2.5% down, 2.5% up, more than 2 deviations, we're saying, hey, they're actually about 3 times wider or fatter of a tail than what the market expects. So if they're saying 2.5% on each side, it's actually happening about 7.5% on each side, or 15% total. That's threefold wider or fatter of a tail end of the distribution, and that's where Soros said he usually made the best money and the most money. And that's how a lot of the hedge funds, which of course a hedge fund has become a dirty word in the post-Madoff world here. But bottom line is that back when Soros was doing it, where a hedge fund was truly geared around strategies that could benefit on both sides of the market, and Soros was known, by the way, for using the foreign currencies quite a bit. He's the one who broke the Bank of England back in the 90s and made $1 billion betting against the British pound. So here, a lot of the big players have focused on foreign currency as among the deepest markets in the world. So it's another attraction of why you should consider foreign currency as part of your portfolio. Just making sure, let's see, looks like we've answered the questions. Feel free to submit questions as we go through here through the chat window as well. I'll try to keep an eye on those. This is an example Steve was talking about. This was back last year, and we were looking at the, actually I think the end of '07, we were looking at the CDD, the Canadian dollar, the U.S. dollar against Canadian dollar. And so here you'd seen a situation in which when Steve and I were talking about it, and it was about in this area back in October of the prior year, that we'd had this already declining period. We've got our acceleration bands in blue, so I should probably draw that in for you so you can kind of tell the difference of what these bands are measuring. So that these what I call 20-day acceleration bands, this is the 20-day upper acceleration band, and so you can see the upper band, of course, is plotted above the 20-day moving average, and the lower blue line there is the lower acceleration band, and so that's an example of what an upper acceleration band looks like. In contrast, you can see in the kind of fuchsia-colored line, purple-pink line there, that we have a situation there in which that's actually the 20-day Bollinger Band there in that kind of pinkish color there. So that you can see the difference in how these two bands will react. Both of them are based on the 2 deviation here. So the 20-day Bollinger Band, you can see, is more quick to try to race to catch up. And what you'll notice is that when you get into strong trends, we're going to talk about percent R here in just a little bit, but just showing you the difference in acceleration bands versus Bollinger Bands, that there's a sweet spot there where when you see the in this case, the U.S. dollar breaking down against the Canadian dollar. So the U.S. dollar is weakening in September here, and the Canadian dollar is strengthening, and/or, I think most of this weakness back in the fall of '07, I believe this was keyed off of the dollar's weakness. Well, you can see the dollar is weak, and it's staying weak from mid-September for quite a while. Of course, we saw the same kind of pattern in the stock market this past fall, in the fall of '08, as the market broke down and kept on downtrending. We love these kind of big trend scenarios. This is where we typically make the best money especially in our option trades. Because you can see that even as we get partway through here, and we're coming right back into the band, as Steve was saying, we were trading up there around 97, and then bam, we're headed down to about 91 over the next 2.5 weeks. So you have a situation here in which, there's still plenty of meat on that bone. As a trader, a lot of us get in that mindset where we say, oh, I've missed out. I've already missed part of that move, so therefore I'm going to be chasing it here, so I'm going to really cost myself. Well, we're going to talk a little bit later about what I call low-risk entry points, where even once you've seen the trend develop, you can still find low-risk spots back onto that trend. Let's see, we're getting a couple of questions here. Bill asked about, would it be fair to say if he followed the swing trading strategy he uses in the spot market to predict price action would be a good place to start in the FX options trading? I mean, yeah, clearly, whatever vehicle you follow, these vehicles, of course, are trading, at the whatever that real-time price level is for, say, the dollar against the Canadian dollar, and then you're basically, all your options are priced against those levels. So, this is where we're seeking to say, okay, through a strong window like we saw from mid-September of '07 to early November, you want to take advantage of that downtrend. What's interesting is then you saw, we look for usually 2 closes in a row above there. The second close in a row above the upper band was back in mid-November, and then this trend went the other way. It started to go back to the upside, so then you were moving back this way. And so you can see that, that gives you a window of opportunity, whereas if you're in a trading range where you're just not getting going, like what you saw on the left side of the chart, you can see that we really wouldn't want to trade through this window. Let me get my color changed there. We wouldn't want to trade through a window where you're seeing, market basically stuck, not getting outside of those bands. And you can see those bands serve as sort of the support and resistance there in August, early September, until we break down below that lower band. So that will kind of help automatically draw in the support and resistance lines that, in my view, you should be looking at rather than getting hung up in, kind of manually drawing that. Mina asks, how do I calculate acceleration bands? It's a little bit more in-depth calculation, but it is in my home study course. You can just call us at our 800 Big Trends number. We can get you more information about that, and we have some kind of introductory information on acceleration bands on the Big Trends website as well. So this is something very unique to Big Trends that I developed. It's been very, very popular. So that's an older example, but one in which it's worth just being aware of how that works. And then we mentioned also we want to talk about other indicators that help confirm that accelerating, speeding up trend. And ironically, one of the ones that I find that really helps me is using this %R indicator, Williams %R, called the percentage range indicator that Larry Williams developed, in a completely different way than I use it than I think what Larry or anybody ever intended. And why do I do that? Just because my testing showed that that's where I had an edge. That's where I had an opportunity to do something kind of unconventional, whereas most of the traders are focused on the conventional wisdom. I'm typically looking for something that's an unconventional approach that gives me a positive edge, an expectation that over time I can make money with that particular unique approach. My belief is usually if you're doing something that everybody else is doing in the markets, that's why, for example, tips usually don't work. We hear a lot of people talking about something that's going to happen. Well, of course, it's been baked into the cake at that point. The markets have already expected it at that price level, and now it's about the surprise from that price level.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.